If you want to make a costly mistake with index funds, you do not need bad luck. You only need impatience. I have watched people work hard for decades, save faithfully, do almost everything right, and still weaken their results because they turn a simple idea into an emotional game. The mistake is rarely that they chose an index fund. The mistake is what they expect that fund to do for them. And most of the time, they expect the wrong thing. When people hear the words index fund, they often relax too quickly. They assume simple means foolproof. They assume safe means no thought required. They assume low effort means no discipline required. But an index fund is only a tool, and like any tool, it works well in wise hands and poorly in restless ones. The fund is simple, human behavior is not. If I were sitting across the table from you, I would tell you that most investing problems do not begin in the market, they begin in the mind. They begin when a person confuses action with progress. They begin when a person wants reassurance more than results. They begin when a person starts chasing comfort in the present instead of freedom in the future. That is where the real damage starts. One of the biggest mistakes people make is believing an index fund is a magic shortcut instead of a long road. They buy it with a long-term label in their mouth, but with a short-term clock in their head. They say they are investing for 10 or 20 years, but after 6 months, they are already measuring success by headlines, by fear, by boredom, by whether someone else seems to be getting rich faster. That is not long-term investing. That is short-term anxiety wearing a long-term costume. I have learned that most people do not lose discipline all at once. They lose it in little moments. A bad month makes them nervous. A good month makes them overconfident. A sharp drop makes them question their plan. A hot trend makes them feel left behind. And slowly, without realizing it, they stop treating the index fund as a vehicle for steady ownership and start treating it like a test they must pass every week. No one can invest well under that kind of pressure. The first mistake is buying an index fund without understanding what job it is supposed to do. Many people buy something because the name sounds smart, the chart looks impressive, or someone online said it was the right move. But they never stop to ask the most important question. What role does this fund play in my life? Is it meant to be the broad foundation of my wealth, or is it just one narrow slice of the market? If you do not know the answer, you are not investing with clarity. You are borrowing confidence from other people. I have always believed that what you own matters less than whether you understand why you own it. A person who owns one sensible fund for the right reason is often in a better position than a person who owns 5 funds they cannot explain. Complexity can make people feel intelligent, but feeling intelligent and building wealth are not the same thing. In fact, complexity often hides confusion, and confusion is expensive. Let me put it in a very human way. Imagine building a house for your family. You would not begin by collecting random materials because each one looked attractive on its own. You would begin with a plan. You would ask what kind of house you need, what weather it must endure, how long it must last, and who will live inside it. Investing should be no different. Yet many people buy funds the way they buy gadgets. They are reacting, not planning. The second mistake is chasing the most exciting index instead of the most useful one. This happens because people are not really buying the fund. They are buying a feeling. They are buying the hope of speed. They are buying the fantasy that they can avoid the dull years and still arrive at the same destination. Broad, sensible investing can feel too quiet for people who have been trained by noise. So they drift toward the narrow, the fashionable, and the dramatic. I understand that temptation. Human beings are drawn to stories. A fund focused on one booming sector tells a stronger story than a broad fund that quietly owns hundreds of businesses. One sounds exciting, the other sounds ordinary. But over a lifetime, ordinary is often exactly what works. You do not build wealth by constantly asking what feels thrilling. You build it by asking what is durable. Excitement is a poor filter for financial decisions. A narrow fund can rise fast for a time, and when it does, people begin to confuse momentum with wisdom. They start to believe they have discovered a smarter path. What they usually discover is a more emotional one. The more concentrated the story, the more violent the feelings around it. And the more violent the feelings, the harder it becomes to stay rational when prices swing. A person who cannot stay rational cannot stay invested. And a person who cannot stay invested cannot fully benefit from compounding. This is why I have always admired simple approaches that leave less room for self-deception. The market will already test your patience. It does not need your help. You do not need to add extra drama by building a portfolio around whatever happens to be popular. A good investment plan should make it easier to behave well, not harder. That is one of the most overlooked ideas in all of personal finance. The third mistake is paying too much attention to price movement and too little attention to behavior. People love to compare returns, but they rarely compare reactions. They ask which fund went up more, but they do not ask which fund they are actually capable of holding through fear, boredom, and uncertainty. That is the question that matters. A strategy is only useful if your temperament can survive it. I have seen people choose a fund that looked better on paper only to abandon it the first time the road got rough. Then they blame the market, they blame the economy, they blame the timing. But the real issue was simpler. They chose something their emotions were not prepared to carry. Investing is not only an intellectual exercise, it is a behavioral one. The best plan is not the one that impresses people at dinner. It is the one you can follow when no one is clapping. There is a quiet truth here that many people resist. Most of the money in long-term investing is made by staying put while your mind begs you to move. Not because doing nothing is always wise, but because wise action is rare and emotional action is common. With index funds, especially, the discipline is often not in finding the next thing, it is in refusing to interrupt a sound process. That sounds easy when markets are calm. It becomes very hard when your feelings get loud. So before you ever buy an index fund, I would want you to slow down and ask yourself three things. What am I trying to build? What kind of ride can I honestly endure? And can I explain this choice in one calm sentence without using the words hot, top, best, or booming? If you cannot answer that, it does not mean you are incapable. It simply means you need more clarity before you commit capital. People often think better investing starts with better prediction. I do not believe that. I think better investing starts with better self-knowledge. If you know your tendencies, you can design around them. If you know you panic easily, you can keep things simpler. If you know you're attracted to noise, you can build rules that protect you from it. If you know you are impatient, you can stop mistaking movement for progress. Self-knowledge is an underrated financial asset. An index fund can be one of the most powerful tools ever given to ordinary people. But its power is not in making you feel clever. Its power is in helping you stay consistent. It gives you a way to participate in the long-term productivity of businesses without needing to outguess everyone else every morning. That is a gift. But it only becomes valuable if you stop demanding entertainment from it. And that brings me to the deeper point. Most people do not fail with index funds because the funds are flawed. They fail because they bring the wrong mindset into a good vehicle. They want certainty where only patience is available. They want speed where only compounding matters. They want comfort where discipline is required. Until that changes, even simple investing can become difficult. In the next part, I will walk into two more mistakes that quietly hurt index fund investors for years. They sound reasonable on the surface. In fact, many people call them smart. But they can slowly drain confidence, weaken discipline, and pull a person away from the very simplicity that made index investing powerful in the first place. The fourth mistake is owning too many index funds that do the same job. A lot of people think more funds automatically means more diversification. In reality, many of them are just buying different wrappers around many of the same companies. They feel safer because the portfolio looks larger, but it is often just more crowded. And when a portfolio gets crowded, clarity starts to disappear. I have seen people begin with one broad market fund, which was already enough to give them a strong foundation. Then they add a large cap fund because it sounds more focused. Then they add an S&P 500 fund because it feels essential. Then they add a growth fund because it has been performing well. Then they add a technology fund because the future sounds exciting. By the end, they think they have built something intelligent, but in many cases they have simply built overlap. The danger of overlap is not only mathematical, it is emotional. When you own too many funds that behave in similar ways, you create more numbers to watch, more returns to compare, and more chances to doubt yourself. Instead of staying calm, you begin judging each position every week. One fund looks better than another, one feels disappointing, one looks stronger, one feels useless. Before long, you are no longer acting like a patient owner, you are acting like a nervous manager of constant small decisions. A good investment plan should reduce unnecessary decisions, not create more of them. That is why simplicity matters so much. Simplicity is not a lack of intelligence. Simplicity is often proof of it. It means you know what you are trying to do, and you are not adding extra moving parts just to feel sophisticated. In investing, sophistication often impresses the ego more than it improves results. I have always believed a portfolio should be understandable on a bad day, not when the market is rising and everybody feels clever. On a bad day, on a day when prices fall, headlines get darker, and your emotions begin asking dangerous questions. If your portfolio is simple, you can remind yourself why you built it that way. If it is cluttered, you may not even know what you truly own. And when people do not understand what they own, they usually do the wrong thing at the wrong time. Now, there's another mistake that hurts people quietly over the years. It sounds disciplined on the surface, but it often becomes a trap. That mistake is changing your approach again and again because you are reacting to recent performance. A broad fund feels too slow after a narrow fund has a big run. A value fund feels weak after growth has been strong. An international fund feels unnecessary after domestic stocks lead for a while. So people move things around, not because their life changed, but because their feelings changed. That is one of the most common ways investors damage a sound plan. They begin with long-term logic, but then they let short-term movement rewrite their decisions. They tell themselves they are being smart, active, flexible, informed. But many times they are simply chasing what already looks good. Human nature is drawn to what has recently worked. It always has been. The problem is that investing rewards discipline more often than it rewards emotional reaction. The market will constantly tempt you to believe that the best investment is always the one that has been winning lately. That belief is dangerous because it trains you to trust performance more than principle. You stop asking what fits your goals, your temperament, and your time horizon. You start asking what looks strongest right now. And once that happens, your plan is no longer built on wisdom, it is built on mood. I want to be fair. Sometimes a change really is appropriate. Person gets older, responsibilities increase, income changes, risk tolerance becomes clearer. Those are thoughtful reasons to adjust a portfolio. But shifting from one index fund to another just because recent returns make one look more attractive is usually not thoughtful. It is usually emotional. And emotional decisions, repeated often enough, can quietly destroy the advantage simple investing was supposed to give you. There is an irony here that many people miss. They choose index funds because they want simplicity, but then they bring speculative habits into a simple strategy. They check too often, they compare too often, they tweak too often. They want reassurance every month. They want proof that their decision was perfect. But long-term investing was never meant to provide constant emotional comfort. It was meant to reward patience, discipline, and consistency. If I were speaking to someone just getting started, I would say this: choose a sensible structure. Understand why you own it. Keep your costs low. Avoid unnecessary overlap. Do not keep rearranging your plan every time leadership in the market changes. And most of all, give a good plan enough time to work. Time is not just part of investing. Time is the force that makes the whole thing meaningful. So, when I talk about the 4 index fund mistakes most people make, I am really talking about behavior. First, people buy funds without understanding the job those funds are supposed to do. Second, they chase excitement instead of usefulness. Third, they create overlap and call it diversification. Fourth, they abandon consistency because recent performance seduces them into changing direction. Those mistakes may look small in the moment, but over many years they can become very expensive. The good news is that you do not need brilliance to avoid them. You do not need secret knowledge. You do not need to outguess the market every year. You need honesty about your own behavior. You need patience when the process feels boring. You need humility to accept that a simple plan followed well can beat a clever plan followed poorly. That lesson may not sound exciting, but it has built more lasting wealth than excitement ever will. In the end, the real advantage in index fund investing is not information, it is behavior. The investor who stays clear, calm, and committed to a sensible plan has a stronger edge than the investor who keeps searching for a more thrilling answer. When you understand that, you stop asking how to make investing feel more exciting. You start asking how to make your behavior more dependable. And that is the kind of question that can change your financial life.